This is the final week of our 3-week Back to Basics program. As we mentioned last week, soon you will notice a change to the podcast. We are introducing video, and we're super excited about it. You'll still be able to listen to the podcast as you currently do, but we'll also post video on our YouTube channel of the podcast. So be sure to subscribe to our YouTube channel at Left Field Investors. For today's episode, we are re-releasing part 2 of our exclusive masterclass on building wealth through passive investing. We did this in 2021. We partnered with TribeVest and their chief storyteller, Julian McClurkin, and we talked about everything to do with passive investing. The episode last week focused on what is passive investing? What is a syndication? What are the pros and cons of passive syndications? And again, the most important topic, how to pick a sponsor. So if you missed last week, make sure to go back and listen to that one first. Today, we're going to talk about how to pick an asset class. How can you diversify by market? How do we choose a deal? What to expect when investing in a syndication? And then we close with how do you invest with a tribe? So the content of the masterclass continues to be relevant 2 years later. We're super excited to revisit the masterclass. So check it out. TribeVest, Julian McClurkin, and the masterclass on passive investing, part 2.
This is now chapter 5, and we're going to focus on how to pick an asset class. Jim, how do you decide what asset class to invest in?
Well, you got to start first by knowing what are the options, right? And there are a lot of options. So you have the first, the most popular, multifamily, self-storage, mobile home parks. That's what everyone's after these days. You also have triple net leases, either industrial or commercial. Now, triple net means the tenant pays real estate, taxes, maintenance, and repairs, and the insurance.
Ooh, I like that.
Exactly.
It's like a triple double.
Yeah, triple nets are great. I love those too. And then office and retail are pretty common also, but they are not as popular now given the pandemic and what that's done to those industries.
What are some other classes?
So some of the lesser known classes would be ATM machines, private notes, so mortgage notes, private lending, assisted living facilities, resort properties, agriculture, student housing, oil and gas, and then development.
That's a pretty long list. I wouldn't even know where to start.
Start with what you know, right? So you probably have lived in an apartment at some point. You might have used a self-storage unit at some time. You've probably used an ATM before, right? So start with the things that you know and understand, and then branch out from there and figure out, is there something else I could do? A lot of people, I talked about this, a lot of people get started flipping single-family homes, and then they move on to maybe buy and hold, and then they move on to maybe buying small commercial multifamily properties. And so if you do that, you'll get a sense of, okay, now I'm going to get into this syndication thing and do it passively. And so then maybe you go into an apartment building. And then you learn about apartment buildings and you learn how great those are. And then you think, everyone's talking about mobile home parks. Well, now you have some experience with investing in places where people live. Now you say, okay, how do I transfer that to a mobile home park? So you just kind of keep going, use your community. Mm-hmm. That's where I keep saying it, Left Field Investors and TribeVest, they help you learn more stuff, right? So you could talk to other people that are investing in these other assets and find out what works best for you. Because there's some people that specialize in one or the other, and there's syndicators. Usually the syndicators only do one thing, but they're branching out also. So you got to make sure that they, for example, one of the syndicators I really like, they're multifamily properties. That's all they ever did. They started into self-storage. Mm-hmm. Now, if they try to do that themselves, there's no chance I would invest with them.
Yeah.
But what they did is they hired a self-storage expert as a full-time employee who's done it for 30 years. And so, okay, now I can go and evaluate their deals. That makes sense.
Mm-hmm. Because now they're bringing expertise into the deal with them. Right. With all of these different asset classes, is there one that's like more safe than the other? I know as I'm looking at this list, the first one that I actually got involved in was probably mobile home parks. I purchased my first piece of real estate. It's not even real estate. Was a mobile home, and I bought it for like $1,000, fixed it up, and resold it for like $7,000.
Nice.
Yeah.
Yeah, I think it's difficult to know what is the safest. One thing that people say a lot is you always need a place to live, right? So if you're investing in multifamily apartments or you're investing in mobile homes, people are always going to need those. So that might be the safest, but really all of these are an asset, right? It's a real asset. It's not a piece of paper. You're investing in an asset. So it's very rare that any of these go to zero. Is there risk? Yes. I think the risk is a lot less in real estate and most of these assets than other things that you're in. But then if you're going to do resort investing, or you're going to do retail or office right now, right after a pandemic, those might have a little bit more risk. Or assisted living facilities, right? You're waiting for demographics to make those a great investment, but they probably will be. So you just have to do your research and understand, where you're comfortable. Start there, and then you'll start branching out. And one of the things that everyone talks about in our group is the shiny object syndrome.
Oh yeah.
So shiny object syndrome, I think of it as the movie from Up, Squirrel, where the dog called Squirrel running around. And I had that, right? When I first started in passive investing, I had an old 401k, right, that I rolled over. And I turned it into something I could invest out of. That's a whole different story. But I was investing in all kinds of different stuff that I didn't vet properly because I didn't know what I was doing yet, because I had that shiny object syndrome. I'd be talking to you and someone would say squirrel, and I'd run over there and go invest in whatever they told me to invest in.
Yeah.
And so that's part of why we started Left Field Investors, was to give people, okay, you can still do the shiny object and run around, but maybe just invest in things that you know and understand.
Is there a strategy involved when it comes to selecting your asset class you want to invest in?
Yeah, I think after you've kind of gotten through the beginning stage where you're only investing in a couple things, and most people probably start with multifamily homes and multifamily apartment buildings, and that's probably a smart way to start. Then you need to start thinking, where do things fit in your investment portfolio? Are you investing for cash flow? Are you investing for appreciation? Are you investing for both? So an example would be, if you're investing, if you're doing private lending, right, you're not going to get any appreciation there. So if you're trying to grow your wealth, private lending probably isn't the best place to do that. If you're investing for cash flow, you might want to invest in ATMs, and there's no appreciation there. You just get cash every month, and then at the end, you've been paid back plus some, but there's no asset left.
It's literally cash flow.
Yeah, exactly. So you have to match what you're doing with everything else. And also, if you want major tax write-offs, again, ATMs is a good investment, and others aren't as good. So you need to try to match your strategy to the asset class. And as you grow and learn and get into the syndication space, you will find all these different asset classes that you didn't know of, and then you could start picking the right one for the strategy at the time. So when I first started, I had sold all of my multifamily properties. So I had a big tax liability. My accountant said, you need to do a lazy 1031, right? So what I did was I found a syndicator who did a great job of doing that bonus depreciation that we talked about, that gave me these big losses that I could use to offset my gains. So that's why I picked that strategy. But then I kept investing with that operator because I liked them, but I had switched, and now I needed cash flow, right? Because I wasn't working my W-2 job anymore. So now I was investing in these deals that didn't have a lot of cash flow, but that's what I needed. And so then I realized, okay, I need to change my strategy because I've written off all this tax liability I can. Now I need to go start investing for cash flow. And so that's kind of how you do it. You have to figure out what you're looking for. You want to diversify, but you don't want to diversify just for the sake of diversifying. You need to make sure that you have a good strategy for how you're accumulating your assets and how they all work together.
When you say you're able to record major losses when you went with that syndicator, it was as a result of you investing in that syndication. That reflects a loss on your taxes?
Yeah, so it's the bonus depreciation, the cost segregation that we talked about earlier. So that's the one where I invested $50,000, and on my K1 they sent me back a $55,000 loss.
Yeah.
Which was great because it's a paper loss, and what that does is I can offset that $55,000 can offset the gain I had from selling another property. So if I had a capital gain of $60,000, now I only have a $5,000 gain, and so instead of paying taxes on $60,000 or whatever the numbers were, I'm only paying it on $5,000.
Okay.
And that's where you make your money, right? Because now you're not paying tax.
So that concludes chapter 5. On to the next chapter. Welcome back to the masterclass. We're now on to chapter 6. We're flying through this thing. Now, you talked about how to pick a sponsor and an asset class. The third way you talked about was diversifying by market. Can you tell us about that?
Yeah, so you want to be in different markets. You don't want to be in all, everything in Dallas. You want to diversify a little bit, but you want to be in good markets. So you have to find markets where sometimes the popular markets are a good place to start. Right now, it's Phoenix, Dallas, Atlanta. Those are some of the popular markets. It's also, I think, I like to look for off markets that aren't popular yet, like Boise is one, Colorado Springs is another one. So you want to find markets that are either good now or are going to be good.
Well, what separates a good market from a not so good market?
One of the main factors to call it a good market is population growth, right? You want people to be moving there. So whatever the reason is or why they're moving, a lot of people are moving to Dallas, a lot of people are moving to Texas, to Florida, some of the Sun Belt states, Arizona. So the more people there are, the more they're going to need real estate, right? So you follow the population growth. Another good aspect of a market would be where the state has good landlord-tenant laws, meaning in favor of the landlord, or they have no taxes like Florida, so there's no state income tax, so that helps you out. There could be, they just have nice business regulations that are business friendly. So all of these things make a good market. You also want job growth. And if people are moving there, they're generally moving there for jobs. But you want strong, stable, and diversified jobs. So you don't want to, go to a town that maybe a military town, because if the military pulls out, then there's no jobs left. So you want to have a diverse economy with a lot of different employers. And hopefully you could get a place where major companies are moving their headquarters or they're moving large, groups of people there. And so job growth and population growth are some of the big factors.
Well, you've labeled what a good market is. What's a not so good market?
Well, I would say it's kind of just the opposite, right? It's people are leaving or there's high regulation. So a bad market would be, a place like maybe New York that has high cost of living, people are moving out, there's high regulations. But it doesn't always have to be a bad market. I'm also investing with a guy in New York because he's a local guy and everyone looks at New York and says, bad market, not going there. Well, he's a local guy. He knows how the rent control works. He knows how everything works. People have to live, right? Somewhere.
Yep.
So he is successful there. Now, I typically don't go in New York for my investments, but you find little pockets. And so part of it is you want to find either a good market or find an operator who has a good story in a bad market, because that can be an advantage too. And other things you can do when you get an actual deal is you can go onto Google Maps and just take a tour, right? See what's around it. You could be in a place that is a bad neighborhood, but they're building a brand new Walgreens across the street. Well, Walgreens does a ton of research. So if they're building there, chances are that neighborhood's going to turn around, right? You can go on Trulia and they have a crime map. And so what I do is I type the address in, put it on Trulia, and I'm just looking for how blue is it compared to the neighboring places, right? So there's a lot of things you can do to look at so you want to analyze the overall market, but then when you're analyzing a specific deal, then you look at the sub-market in the very small area where the property is.
Right.
One other thing that might be helpful when you're trying to select a market is a market that you're familiar with, right? If you grew up in Indianapolis and you know something that everybody else doesn't, then that might be a good place to invest in because you know how the market operates. Also, again, I keep saying it, use your community, right? If you want to know what a good market is, ask some other people that are investing.
We've screened a sponsor, we selected an asset class, and we picked a few of our favorite markets. Now we're getting into deal flow. How do we choose the deal we want to invest in?
That's a great question. I'm a passive investor. I do not want to re-underwrite the deal. That's the job of the sponsor, right? So I've done a great deal of work evaluating the sponsor, getting to know, like, and trust the sponsor, and I understand that they know what they're doing, and I'm confident in them. So I don't want to do their job and dig into everything and figure everything out from scratch, right? That's their job. Now that I have confidence in them, I'm going to trust that the deal meets most of my metrics. So, but I still want to check. I still want to make sure. And the funny thing is, this is probably the shortest chapter, how to analyze the deal, because what you really want to do is make sure you have the right sponsor, the right asset class, and the right market. Those are the tough parts. Now, when the deal comes, you look at it and you're like, okay, I knew this was coming. And so what we do at Left Field Investors, we created what we call a deal analyzer. And so we take maybe 30 different metrics and we put them in our deal analyzer. And it's an Excel spreadsheet that turns green if it fits our parameters and red if it doesn't. And so red doesn't mean don't invest. Red means this generates a question. And how I use this is as another check on the sponsor. I'm checking the deal to make sure it fits my metrics. And we'll talk about a few of those. But I really am also checking the sponsor. So what happens is, let's say I get 5 red flags. So I'm going to contact the sponsor and say, hey, I got questions on these 5 things. Now, I'm not as concerned with what the answer is. I'm more concerned with how it's answered. are you responsive? Do you get back to me within 24 hours? It sounds like that's a little too nitpicky, but if you don't get back to me before I've given you my money, are you going to get back to me after you have my money? Probably not. So that's a test. The other is, how do you answer my questions? Do you know the answers, or is it difficult for you, or do you get upset that I'm asking questions? All of those are red flags. Like, most sponsors are going to give me very detailed answers, and that makes me not only feel better about the deal, but it also makes me feel better about the sponsor. So I focus on the metrics through the deal analyzer, and that's how I vet a deal.
Yeah, I like that. Well, let's bring up these metrics. What are some different metrics that you look at?
So, like I said, there's about 30 of them on that tool that we use, but everybody, I think, has their favorites. And some of the favorites that I have are rent growth, right? I want to see that and this is all looking at the pro forma. I want to see that they've had reasonable rent growth. I don't want to see 10% rent growth in year one.
What's a pro forma?
Oh, thank you. So pro forma is kind of a prediction of how they think the financials will perform over the next 3, 5, 10 years, however long their time horizon is for that investment. So you're looking at, they do full financial reports based on assumptions that they make, and that's the pro forma. So the rent growth pro forma, if they say they're going to get rent increases of 10% in year one, I wonder how they do that.
Yeah.
Because most of the leases don't, they come due every, on all kinds of different dates. So how are you going to get everyone up 10% immediately? You're not. So a lot of syndicators will use, overly aggressive assumptions on rent growth. So, but if I see one that's 2 or 3% every year consistent rent growth, that makes sense, because you not only, and it depends also if they're a value add property, which means an old property where they put a bunch of work into it, you should be able to get more rent increase, right? Maybe you can get 4% a year. If it's a property that was just built 3 years ago and there's no work to do to it, you might only get 1 or 2%. But those numbers have to be consistent. They have to make sense based on the property.
What are some other more important metrics?
So another one I like is break-even occupancy. So break-even occupancy is the amount of vacancy you can have and have the property still break even. So that just that shows you how much buffer you have. And I like to see at least 80%, no higher than 80% break even, because if something goes wrong and occupancy drops to 90 or 85%, I know that we're still making money and we would break even at the 80% mark. So the lower that number, the better. Another one that I like that I didn't even understand before was economic vacancy. So it's not vacancy, it's economic vacancy. And when I owned single family properties, I always threw in 5% for vacancy, right? Just in my underwriting and evaluations.
Right.
Well, there's more to vacancy than just someone not being in an apartment, right? So economic vacancy includes vacancy, concessions, which is, throw in a 3 months rent or a TV if you sign now or something like that. Bad debt, which means uncollectible, stuff you didn't collect. Loss to lease, which is the major one. So loss to lease is if the market rate for an apartment that like you have is $1,000 and you're only collecting $800, that's $200 of loss to lease.
Oh.
And so that's a real driver, right? If you have big loss to lease, you get rid of that, then your vacancy goes way down. And then there's actual vacancy. And then the last one is non-revenue units, like if they convert one unit to storage or something like that. So all of those add up to economic vacancy. And I like to see that economic vacancy at about 8%. If it's much lower than that, then that's one of the questions I ask. Why is economic vacancy so low? If it's below 5%, then I'm having a hard time believing it, unless it's in some place like Boise, Idaho, where someone told me there was like 3 vacant apartments in the whole town. Yeah. So those vacancy numbers I would believe, but you always have to put everything in context.
So economic vacancy includes that 5% of regular vacancy that you would typically budget for.
Yes, absolutely. Okay. It's all of those.
Okay, sweet.
Yeah. And so another metric I like to look at is property taxes. So usually when someone buys a property, the county reevaluates the taxes based on the new price that you bought it at, right? So taxes should be higher. And so what I look at in the pro forma, which is a prediction of what the tax burden will be, is I want to make sure that the current taxes are lower than what they're projecting in the future because you're expecting the taxes to go up. So I just like to make sure, that's another place where a syndicator could kind of fudge the numbers to make returns look better, but in the end, they won't be better.
Is there anything else with regards to the metrics?
I think everybody needs to find their 4 or 5 favorite metrics or what they really want to look at and concentrate on those. One of the things, and I mentioned this, but I think it's worth repeating, is that part of the process of evaluating the deal is the continuation of the evaluation of the sponsor. And so I really use the deal information, the deal metrics, to do a double check on the sponsor. Do they understand the deal? Do they know what they're doing? Are they going to communicate with me? And are they going to be responsive? I think those are super important things because there's nothing more frustrating than sending someone $50,000 and not hearing from them again.
From what I gather, passive investing doesn't seem so passive after all we've talked about. We've gone over how to pick a sponsor, an asset class, a market, and a deal. But can you kind of put a bow on this and put it all together for us? Can you talk me through the process of investing in a syndication?
Sure. So you're right. It doesn't seem passive because it is very active at the beginning when we're doing all those things you just mentioned, right? Screening the sponsor, the deal, the market, the asset class. It's afterwards that becomes more passive after you've made the investment. And also, once you get more experienced and you build a relationship with a syndicator, it's going to be even more passive because you'll know the deals that they're going to send you and you'll spend even less and less time on each deal. So it is active in the beginning, but it becomes less and less as you move forward.
Okay, so let's break it down step by step for our viewers who have been watching. What's the first thing we need to do? What do we want to do before we actually invest in this syndication?
Okay, I like breaking it down this way. So first, you want to find a sponsor. And again, Left Field Investors, we have a sponsor overview, which is kind of small summaries of a bunch of different sponsors. We also have the sponsor screener, which helps ask you questions. So again, if you're using your community, this is helpful. So first is find a sponsor. And to do that, you need to interview a sponsor, review that sponsor's past deals, and you can use our deal analyzer to do that. And I recommend people looking at past deals and ask the sponsor, hey, can you send me your last deal? So you can kind of get a feeling for it when the actual deal comes in. Mm-hmm. And then when they send you a current deal, you're going to want to analyze that deal using whatever tools you have. Then you're going to make your investment decision, and you're going to say, yep, I'm going to do it. And if you're going to do it, you submit what they call a reserve. Now, there's hard reserves and soft reserves. Soft reserves are ones that you can back out of. You can say, yep, I'm going to invest $50,000 in this, because sometimes you have to invest before you have full information. You have to commit because there's so much capital on the sidelines waiting to invest. Mm-hmm. So that's a soft reserve. You can back out if you want. Then there's hard reserves, which is if you back out, that syndicator will not likely ever let you into a deal again. Wow. So a hard reserve, you need to know you're making a hard reserve, and you can ask them, "Hey, is this can I submit a soft reserve, or is this more committed than that?" And then in that process, you may also have to show that you're accredited if it's a deal that requires you to be accredited. And for that, they either have you fill out a form, like there's websites that'll prove that you're accredited, or if you have an accountant, they'll often write a letter that says yes, he's accredited.
Okay, so that takes care of everything we need to know before the actual syndication. But now we've sent that reserve. What are we doing now during the syndication?
So you're still kind of in the before, but you've made the decision. So the during, to me, this is when you are signing the subscription document. So you've already committed. So now they're going to send you all the documents you need to sign. Yeah. So you're going to review and sign the subscription document. You're going to sign the PPM, the private placement memorandum. You're going to review the operating agreement, make sure that's all good to go. You're going to get the wire instructions. Now, this doesn't seem like it's a big step, but for me, what I've learned is you want to get those wire instructions securely, because a lot of the syndicators will just send it in an email. And there's been a lot of wire fraud.
Absolutely.
And so what I do is I either get the instructions and call and verify them, or what I usually do is I ask the syndicator to send it in a DocuSign or some other kind of secure document, so that I never wire money just that I got the instructions on email without verifying it. So that's very important. A lot of syndicators they have portals on the internet where you can go in and see the investments, and they'll just post them there. Mm-hmm. So make sure you're sending it securely, then you send the wire, and that's kind of the during. Now you're just done.
Yeah, you want to double, quadruple, triple check that one.
Right, and part of that triple check, thank you for saying that, is once you send the wire, confirm that they got it. Right? I always send an email to the sponsor saying, just sent the wire, let me know when you get it. And then I follow up with them until they give me written confirmation that they've received the wire.
I do the same thing on a smaller scale on Cash App. I'll send $1 first just to make sure they get the dollar. Yeah. All right. So what is the process like after that?
So after is now, we're saying after you made the decision to invest and you've sent the wire. So now we're talking about during the investment. Right now the investment's just going on. So what you need to do is save all the documents. And this is kind of tedious, but if you don't do it now, you're going to regret it. So you save all the documents, right? The signed documents, the PPM, subscription agreement, the offering memorandum where they're giving you all the details. You save all of that stuff, either paper files or you can save it electronically. Then you enter the deal in whatever kind of tracking system you have. Now, this has been a real problem for people is there aren't any official ways to track this. And what you want to track is you want to track your distributions, make sure they're coming. You want to compare those to the pro forma, what they said they would send you. And, if you only have 1 or 2 deals, Excel or something like that is fine. But it gets complicated when you have 20 or 30 deals and you're tracking all this stuff. So at Left Field Investors, we've developed a portfolio tracker. And it's an online web tool where you can put all your deals and it'll help track stuff. So that's what I use. And the things you want to track are the date you invested, the amount you invested, the name, obviously, then the sponsor's name and the entity that owns it, because those are going to be different. How you invested. Did you invest personally? Did you invest your own LLC? Did you invest through your TribeVest tribe or a trust? And then some of the financial assumptions from the pro forma. The expected annual cash flow, the IRR, which is internal rate of return for the life of the deal. I'll talk about that in a second. And then if there's refinances expected, when those coming. And then you're going to track your distributions, compare them to expected, and then you're going to track your K1s.
What was that IRR you were talking about?
Okay, so IRR, it's really complicated to calculate, but basically what it is it's just using the time value of money, saying that if I receive $50,000 today from my investment, that's much better than $50,000 that I receive 5 years from now. So all it does is it brings everything into the present tense as far as money. So it allows you to compare 2 different deals that have incomes at different times and compare them as far as what the returns are.
Oh, okay. Then you'll be able to maybe also calculate if you're missing out on opportunity costs by investing in something quicker, that you'll receive your money back quicker for now.
Exactly. And you always want to, it's a great point, because you always want to receive your money faster and pay your taxes slower. And so if you can figure out how to do both of those, that's how you're really making money.
Nice. That concludes chapter 8. On to the next chapter. Welcome back to the masterclass. You made it to the final chapter, chapter 9, and my favorite chapter. How to invest with a tribe. Jim, you're a part of 5 tribes and you're a mentor of 3. Why are you so attracted to tribe investing?
I love creating and working with a community. And that's part of it. It's the reason I started Left Field Investors, was to learn, network, and grow with other people who are interested in this too. And part of it is these type of investments have not been accessible to everybody. And part of my passion is sharing that anyone can do this. You can do this if you want to do this. And the easiest way to do it is with tribes, because let's be honest, most people don't have 50 grand that they can invest at one time and regularly to get that diversification, right? If you're investing 50 grand, it's going to take a long time to save that up. And tribes solve that problem. Group investing solves that problem. You can get into many more deals. You can have the diversification. You can get into real estate, and you can learn and grow with others. And that's building a community. And that's what I'm passionate about.
5 tribes, are they all investing in like the same thing? Or can you kind of tell me a little more about them?
Yeah, so they're all very different, and they're all established for very different reasons. So I'll go through them so you can understand maybe how tribes work a little bit.
Yeah.
So the first tribe I was in was a couple of my former financial advising clients who they're highly paid professionals, and they want to be in real estate, but they don't have the time and they don't have the desire to learn about it. And they knew I was doing this passive investing, and so we figured, hey, let's do it together. And TribeVest made that super easy. So for those guys, I find deals, I will call or text them and say, hey, do you guys have any capital? If they do, then they'll say, okay, let's do it. If they don't, then we'll wait for the next deal. So they don't get involved in the deals at all, other than knowing maybe the asset class. And they're just relying on me to do that work for them. And the reason why it's fine with me doing that, I'm fine with that, is because I'm doing this investing anyway, but partnering with them, we can get into more deals and we have the whole diversification thing. So this is a very passive, they're very passive, and I'm just finding the investments for them.
Do they supply the money and you supply the expertise?
We contribute equally, but so we split it 33, 33, 34. So I get, of the proceeds, I'll get an extra % for the legwork that I'm doing.
Got it.
And so some of the tribes are set up that way. Like there's another one of my tribes, my second tribe, which somebody else manages. Another one of the founders of Left Field Investors manages. But this one, so I remember I told you about the syndicator that we really liked that was getting me a lot of passive loss through the bonus depreciation. Well, they come out with a deal every month at least, maybe even more, and their minimum is $25,000, and they have great historical returns. So you can't be in every one of those deals, right? Because if there's 12 deals a year at 25 grand, that's just too much. But how do you pick which one to be in? Because you don't know which one's going to be the rock star and which is going to be just average. And for them, average is 30% return. So
it's a great average.
Yeah. So we decided, hey, let's team up. So me and this other founder and some of his family, 5 of us got together and we said, we'll just invest in every deal. So now we put the minimum's $25,000. So every time they come out with a deal, we all chuck $5,000 into our TribeVest account, invest in the deal, and off we go. And that one, the other guy is managing that tribe, and so he takes a little extra cut for doing all the paperwork and all the processing and things like that. So that's a totally different purpose. And that tribe's grown a little bit too, because now we'll also get into other deals that we get interested in. But the one with that sponsor, those are automatic. We don't even talk about those.
That's awesome. I love that. Tell me about some of the other tribes.
So the third tribe I started was for beginners. I wouldn't have had to start this tribe if we had this masterclass. I could have just showed them the video. But basically, this is a mishmash of people. There's 11 people. Some are neighbors. Some are, I have a college friend in there. Some are former financial advising clients. These are people that they don't own any real estate other than their house. And they may never have gotten into real estate, but they heard what I was doing and they were interested. And so we started a group and we started contributing $100 a month. Right? And the minimums are going to be $25,000, right? So 11 people. It took us a while, and then we did a little lump sum. But it was during the pandemic when we did this, so we would do Zoom calls every couple of weeks where I would take a topic and I would explain syndication. I explain all the stuff we're doing here. And at the end, we found a sponsor, and it was non-accredited. This is what made me go find all these non-accredited people. We found a sponsor that we really like. The sponsor actually came to one of our Zoom calls and talked about how he operates and what he does. And then we invested in this apartment deal. And I mean, everyone's excited, right? It's people that, they don't necessarily have the means to put $25,000 in a syndication of their own, but now we're up to $150 a month. It's year 2. We're going to get to the second deal in August. And, it's just growing their portfolios, and it'll be a little extra boost to their wealth. And then they can either invest on their own, start their own tribes. It's just to grow it, right? So it's a learning tribe, and it's one of my favorite groups.
Yeah.
So the last 2 tribes are very similar. They're just made up of members from the Left Field Investors community, people who've heard us talking about TribeVest and are interested, and they just wanted to get a group together. And they're all people who already know a little bit about syndication, but some of these were their first investments in syndications. So this group is a learning group for sure, but they're learning more, not just from me, they're learning from the community. And they form these smaller communities together that are working together to increase their wealth. And that's the goal, right? You want to get in these communities where you can learn together and figure out how to do this syndication thing. And the whole goal is, we're not all trying to become rich, but we're trying to become time independent, right? So you're not trading money for time or time for money. You're building wealth so that you can have these passive investments that you don't have to worry about. If I go on vacation next week, I'm still going to have money coming in. And that's what passive investing is all about.
Out of all of your tribes, how many people are you investing with? Like, how many people are part of each tribe?
So there's a tribe that has 3, a tribe that has 5, 2 tribes that have 11, and another one I think has maybe 10. Yeah.
Wow.
So, and you can have any number. I think a lot of the benefits of the tribe is the community talking together and everything. But once it gets much past 11, I think it's going to be hard to get anything done because coordinating schedules for calls and everything. But honestly, the TribeVest website makes it really easy because there's messaging on there. There's all kinds of, and I think we'll talk about that in a minute. There's all kinds of stuff on there that even makes a large group easy to manage.
Mm-hmm. So you're involved in actively investing with over 30 people. How do you find people to be in your tribe?
Yeah, I never really counted the 30 people, but you're right. So they really just come together for whatever purpose it is, right? I talk about passive investing a lot because I'm passionate about it. And so you can start groups with friends, or you can start groups with colleagues, or whoever your network that you want to work with is. Or some of these tribes, I had people that I never met before. And I met them through a couple TribeVest people had heard of TribeVest, but not left field investors, and they contacted me. And so you want to have some familiarity, right? I think TribeVest a lot talks about investing with family and friends, and that's best. But there are some groups that I'm in where nobody knows anybody. They all know me because of my role at Left Field Investors. And so we've developed trust between me and you, right? So then an acquaintance of yours might then trust me. And that's, you need to have kind of the trust working out so that you can feel comfortable investing with people, because that's a lot of money, right? And again, TribeVest helps with that because the money is secure, it's online. You know, TribeVest has all the procedures and policies that kind of help with that trust aspect as well.
Once you've actually found a tribe, how do you know that everybody's a good fit for the group?
This is a critical step, right? You want to make sure that the tribe is aligned. Everyone understands that this is a long-term investment. You know, I tell everybody there's nothing more illiquid than a TribeVest tribe investing in syndications, right? These are long, and that doesn't mean it's bad. It just means understand that once you join this tribe, you know, you're dating now, but you're going to be married once you sign that LLC. And that means it's going to be difficult to get out of if you want to. So if everyone's aligned and understands, hey, we're investing for appreciation, or we're investing for cash flow, then, you know, you kind of have everyone's understanding, right? So a good example for me is the first tribe that I told you about with 3 people in it, it had 4. And the 4th was my dad.
Yeah.
And it just wasn't a good fit for him, right? So we did all the TribeVest stuff, and he was just having questions about things, and it wasn't the right fit for him. And so we bought him out, and that was fine. There was no hard feelings, but that's great, right? And some of these left field investor tribes that we've started, we'll start out with a group, and we'll have a few Zoom meetings that everyone's talking, getting to know each other and talking about the tribe, and we'll have people drop out all the time, and it's great. And I tell the people to drop out, hey, no hard feelings, because this wasn't the right fit for whatever reason. Better get out now than later.
Yeah.
And then usually a couple more stragglers come in, and we, you know, and then the group kind of coalesces. Before we invest, we probably have 3, 4, 5 meetings, and people get to know each other, and there's emails and all that. So I think that's important. It's to find people that you know, like, and trust, that you want to build a community with. And you know, we've been talking a lot about the TribeVest community, or the left field investors community. But once you form a tribe, that's another small community, right? And so you need to make sure that you have people that you're going to be compatible with.
Yeah, absolutely. You know, in real estate and in business, a lot of times people say stay away from family, like don't rent to your family members, don't don't purchase property with family. But this really does spread the risk sometimes. If you can go into it with the TribeVest mindset and everything is transparent, they can see everything, it's all laid out on the table. Makes it safer to invest with those people, with your family and your friends.
Yeah, absolutely. And you know, talking about that, like how the process works is just you go to the website. Now, when I first started the website, you know, it's grown a lot and it's gotten a lot better. And now people ask me, hey, I need help setting up a tribe. And I say, no, you don't. Go do it. It's easy. And there's one of the guys in one of my groups, I send people to him now because he just set up his tribe. It was super easy. I didn't help him at all. And so people are now saying, hey, can you help me go on TribeVest and start a tribe? I say, no, call Alvin. He'll do it for you because he just did it and it takes 3 minutes.
Yeah.
You know, and there's, when you go online to set it up, TribeVest is going to help you set up your LLC, right? Because you need to form a company so that you're all equal owners, or however you want to set it up. Then you're going to set up voting rules because you want to make sure that if you're making an investment, everyone's on board. And so for my tribe of 3, our rules are everyone has to agree 100% or we don't invest. My tribe of 11, we do 7 people, right? Because you don't want to drag people along who don't want to invest, but you also don't want one person to stop the show.
Right.
And so TribeVest helps with all of that. And they set up a business bank account for you. And then they do the same page, right? So that you talk about alignment and investing with family members. You want to make sure everyone's on the same page. So everyone gets together and figures out, all right, what's the process? What are we going to do? And everyone agrees to it. And that reduces some of the risk of investing with family or friends, I think.
So can you kind of sum up the TribeVest online experience?
TribeVest allows you to do everything from the website, from forming your LLC, funding, doing the banking, doing voting on, are you going to invest in this or that, messaging, and you can store your documents as well. You can even send wire transfers from there, and it is secure. It's just like you're sending from the bank.